So this is part number 21 of this multi-part video series. The series continues because this discussion is extremely important. Now, I don't know whether you have read William O'Neill's book, How to Make Money in Stocks or not. I highly recommend that you read that book because in that book, he talks about the very famous CAN-SLIM system, which has been around for more than 65 years now. In 1963, he was using this system. So I can tell you that it's at least 5 decades old system. And remember in part 2 of this video series, I spoke about the important factors that positional traders should consider when they are trading the weekly time frame charts. And one of those factors was the CAN-SLIM system. Now, much of what you see on this slide is already incorporated in our filters. So for example, the C in CAN-SLIM stands for current EPS growth. So in our fundamental criteria, remember there are 12 different criteria. There are a couple of criteria for EPS which says the current quarterly EPS growth should be 40% or more, and there should be 3/4 of acceleration in the EPS growth. So those two criteria cover the C part of the CAN-SLIM. Then in annual EPS, we have one criteria, remember, out of those 12 fundamental criteria. There should be positive annual EPS growth for the last 3 years for the company. So the EPS growth has to be positive. It could be 1%, 2%, or 100%, doesn't matter. But there has to be a positive growth in the last 3 years. So from third year to second year, if the EPS has declined, and then in the latest year, if the EPS has again gone to all-time high, that is not allowed. There should be positive EPS growth in every one of the last 3 years. So that criteria is there. So that covers A part of CAN-SLIM. N is new product, new management, or new high. To determine whether the company has launched new product or to determine whether there is new management has taken over the company, you can use things like ChatGPT, because ChatGPT is something which can look for information for you rather than you going to Google. Why not just put a question to ChatGPT asking whether the company meets the CAN-SLIM criteria? You can ask that question directly, or you can ask a question to ChatGPT saying, has the company recently launched a new product, or is there new management that has taken over the company? Just ask the question to ChatGPT and see what you get. Okay. N also stands for new high, because a company that breaks the 52-week high is most likely to break out on the upside, right? Because the overhead supply gets cleared. So if there is no new product or new management, at least we look for a new high. Even this is covered in our filters. So if we go to our filters, let me open that. Remember that 52-week high price should be within 25% of 52-week high. So I will go to one. Yeah, see, price percentage change versus 52-week high. It should be within 25% from the 52-week high. So we are looking for stocks which are closer to the 52-week high, so that these are the stocks when they start going up, they are going to create new highs. Okay. So that's what we are looking for. So even that is incorporated. So first three bases are already covered. I will come to the S. L is already covered. L stands for leader. So we measure this with the relative strength. So we are looking for stocks with a relative strength of 70 or more. Have a look at this. See, 70 or more, preferably more than 80. So that's a leader. The other ones are laggards. Actually, the definition of a leader as per the book is a stock in a particular industry which is displaying the highest EPS growth, the highest sales growth, the widest profit margin, the widest return on equity, and the highest relative strength. That's the definition of a leading stock in a particular industry group. It has got nothing to do with market capitalization. Okay. But When I look at the L factor in CanSlim, I look at relative strength. If it is more than 80, fantastic. I'm excited about that stock. Even institutional sponsorship is covered because we look at buyer demand, accumulation, distribution rating. So we want a stock that has got institutional support. So this is A and B, the buyer demand, accumulation, distribution rating. So even that base is covered. And M, as you know, I've already made a video on this. There are four market conditions: confirmed uptrend under pressure, rally attempt, and confirmed downtrend. You know what to do when. You know what position size to take in which market condition. Okay, so out of Can Slim, the six things are already covered. Okay, they are very objective. One, two, three, these are already in the filters. Even the new high is in the filter. Current and annual EPS is in our fundamental criteria. So you don't need to look at the EPS rating or the SMR rating or the master score or whatnot. There are too many variables to look at. But just looking at all this should be more than enough. Apart from EPS, we also have criteria related to sales and return on equity and margin. Okay, important. Have a look at that because in the book, those factors are discussed as well. Now let us come to S. S stands for supply and demand. So let me give you an example to understand. There is no hard and fast rule for this. That is why I don't give much weightage to this. But since it is a part of the CanSlim criteria, let me explain what this is. Okay. See, the number of shares of a company are always limited. So let's take an example. An example would be better for you to understand. Let's say there is a company with 10 million shares outstanding. Out of 10 million shares, 6 million are held by the management of the company. So these are promoter or promoter group related individuals and institutions. So they are less likely to sell their stock. And even if they sell, they have regulatory requirements, they have to disclose and things like that. So the inclination to sell is very low because they are the ones who started the company in the first place. So let's say out of 10 million, 6 million are held by the management. So promoter holding is 60%. Okay. Out of the remaining 4 million, let's say 2 million are held by institutions like mutual funds, insurance companies, foreign institutions, pension funds, things like that. Okay. Now you have remaining 2 million shares outstanding. Okay. Those can be held by the retail public. So the lesser the number of shares available for the public to trade, the more restricted is the supply. And the more restricted is the supply, the greater is the potential for strong price movement. So in this case, the free float is 40%. Free float means the number of shares available for trading in the market. So that 60%, which is held by the management, is not available for trading. Although they constitute a part of outstanding shares, but the remaining 4 million are available as free float, which is available in the market for trading. Out of that 4 million free float, 2 million are held by big funds. Maybe they have held it for a long period of time. So the actual free float could be much lesser than 4 million, right? Not many shares are available for trading. And that's what we want. The more limited the supply, even small demand can push the price up in a single day or a single week by a large percentage. So that is what we are looking for. That's number one. Number two, too much institutional holding is also a big problem. Okay, why? Because let's say the stock is in late stage. Remember early stage, middle stage, late stage. Let's say the stock is at base number 5, and out of 4 million, let's say 3.5 million are owned by institutions, and the remaining half million is owned by the retail public. So this is too much institutional ownership, right? So there is a big risk of institutional dumping. So 3.5 million shares are held by the institutions, only half a million are held by the retail public. So in that case, maybe a lot of institution might come to the market to dump the stock because they've already made a lot of money, because the stock is at Base number 5, which is late stage, it has already run up a lot. Remember, from base 3 to base 5 itself could be a double, like 100% return, 100% or triple digit, whatever. It could be 200, 300% as well. Imagine from base 1 to base 5, how much it would be. It would be like 300, 400, 500% return. I have seen more than that as well. I have seen base number 9 in one or two stocks in the Indian market recently, not late. Okay. I can't give you the name of the stocks, but I have seen that happening. So, too much institutional ownership is also not a good thing because that could lead to great amount of supply. Another point that is discussed in the book is about stock split and uh, share buyback. Stock split is just an accounting, what do you say, an accounting entry where the company is trying to increase the number of shareholders of the company. If the stock price goes beyond a certain point, then they split the shares so that the stock price comes down, but the percentage ownership of the existing shareholders remain the same. So it really does not create any value. It creates liquidity in the shares, but it doesn't create any value. So stock split, companies which are doing stock splits, we have to be careful because the liquidity, as liquidity in the stock is increasing, there is also the risk that supply will come into the market. So we have to be careful of companies doing unnecessary stock splits. We want companies which are buying back their own stock. So let me give you an example. Let's say the same company, 10 million shares outstanding, 6 million are owned by the management, 4 million are available as free float for trading. Company decides that they want to buy back 1 million shares. Okay. So they take money from the accounts of the company and buy back 1 million shares. So now those 1 million shares are extinguished. Okay. So now how many million shares are outstanding? 9 million shares. Out of 9 million, how many are owned by the management? 6 million. So earlier the management ownership was how much? 60%. Now it is how much? It is more than 60% because earlier they owned 6 million out of 10 million. Now they own 6 million out of 9 million. So the management is like consolidating their stake in the company. Okay. Now there could be regulatory issues. I don't know how much percentage should be available as free float for retail public. I have not looked at that in the Indian market. I don't know what the regulations are, how much should be mandatorily held by the retail public. There could be some percentages. But broadly speaking, I am trying to say that if a company has excess cash in their account, they can do three things with that excess cash. Number one, they can either distribute that cash as dividend. Number two, they can reinvest that money back into the business to grow the company. Number three, they can buy back the shares. What else can the company do apart from these three things, right? So if the company is giving out dividends, that means that the company does not foresee future growth opportunities probably. So that is not good. If a company is reinvesting in its own business, okay, like something like Berkshire Hathaway, owned by Warren Buffett, never gave a dividend. That is very good because that's a growth company. And a company which is buying back shares, it's like extinguishing the free float available. So restricting the supply of shares. That is again very good, right? And there is fourth category of company where they do both. They give dividend and they also invest in future growth. Okay. Earlier companies like Asian Paints belong to that category. Okay, because they had so much cash. So companies can either give dividend or they can invest in future growth internally without borrowing money from outside. Then they can buy back their own shares and then they can give dividend and also invest in future growth. We want to see companies where they're either buying back their shares or reinvesting their profits back into the same business for growth. Now there are some businesses where you have a profit but you reinvest that profit just to remain competitive, not for growth. Because the economics of the business is such that if you give the profit as dividend, then you will not remain competitive because you don't have money to stay competitive in the business. So it's a fake profit. Okay. So you see profit on the profit and loss account, but that profit has to go back into the business just to remain competitive because the economics of the business is so poor. But if a company has excess cash, reinvesting the money into the same business and growing the EPS and the sales, that's the company that we want. So if you see a company reinvesting its profits back into the business, but you don't see that reflecting in EPS growth and sales growth, please stay away from that, from such companies. These are big infrastructure companies, capital intensive businesses. Okay. We don't want to get into those unless they have very high relative strength and something is happening inside the company. Maybe new product, new management, something like that. But generally, these companies will not make you money. Okay. So that's a discussion on supply and demand. So it's a very subjective topic. There is no fixed rule for this. That is why I have decided to discuss this thing with you rather than give you some rules. I think ChatGPT would be a great tool to handle these two parts: the new product, new management, and regarding share buyback, stock split. So you can directly put up a question to ChatGPT asking, has the company released a new product recently? Has the management of the company changed recently? Has the company bought back its shares recently? Has the company done a stock split recently? Is the management consolidating its uh, ownership in the company? These 4 5 questions that I mentioned to you, if you simply put this in the chat GPT and mention the name of the company, I think chat GPT is powerful enough to give you some background information about what you are getting into. Okay. So that's a subjective part for which we can use chat GPT. The remaining parts are fairly objective. We have already put them in our system. So our system is very simple. What I am teaching you in this series is not rocket science. You could just, take a piece of paper or buy a diary. Okay, buy a diary and a pen and just write down from part 1 to part 20 whatever I have taught you. Just make notes. You will realize you will create your own system. Okay, you can customize this, you can modify this as per your requirements, but this is the foundation. This is the basics when you're looking at weekly charts. Remember, when you're looking at weekly, there is no need to go to the daily, there is no need to go to the uh, intraday time frame. In 1963, when William O'Neill was trading stocks, there was no intraday, there was no daily time frame. They all looked at weekly charts as well. There was this ticker tape or whatever they used, but he traded with the weekly charts. It's as simple as that. Okay, so you don't need any other time frame if you're using this CanSlim system. All charts, by the way, in the book are weekly time frame charts. Okay, so just master this system. I have already covered a lot of ground for you. It is watching this video series will eliminate the need for you to eliminate or reduce the need for you to read the book, but that does not mean that you should not read the book. If you watch this video series multiple times and you read the book 3 to 5 times, okay, imagine the amount of understanding you will have about the market, and you can actually implement and see for yourself how it works out for you. Is your personality suited to this kind of trading or investing, if you want to call it that way? So look for a stock that comes closer to the canceling criteria. No stock will meet all of the criteria, but there will be stocks which come very close to the canceling criteria. So we increase our odds of success. I will see you in part number 22.